Hey everyone, in today's video, we're going to talk about how our credit scores are calculated. Hi, I'm Star Tower, your financial fitness coach, here to empower you to become financially healthy and to live the life and retirement that you and your family deserve. Welcome to Fitness Friday, where I give you tips and exercises to help you kickstart or continue on your financial fitness journey. So today, we're going to cover a topic that affects nearly everyone, your credit score and how it's calculated. Understanding how it's calculated can give you the power to boost it and unlock better financial opportunities. So if you're ready to take your credit score to the next level, keep watching. So first off, what is a credit score? A credit score represents your credit worthiness. It measures how likely you are to repay a loan or to handle and manage your credit responsibly. In the US, the most commonly used scoring model among lenders is called the FICO score, and it ranges from a minimum of 300 to a maximum of 850. Although the Vantage score scoring model is also used by some lenders as well. Basically, the higher your score is, the more likely that you are to repay a loan and to handle your credit responsibly, and the more likely that lenders are willing to extend you a line of credit. So under the Fair and Accurate Credit Transactions Act, you're basically allowed access to a copy of your credit score report from each of the 3 credit unions once a year for free. And those 3 credit unions are Equifax, Experian, and TransUnion. And I highly recommend that you do this because not only does it allow you to know what your credit score standing is, but it allows you to audit any unauthorized transactions that may have occurred on your account. And this is especially relevant given all the data breaches that have occurred lately. You may have heard of the data breach incident from National Public Data earlier this year. Basically, they're a company that aggregates data to provide background checks, and they confirmed that several millions of American social security information and personal information were stolen from their database. So there are 5 factors that go into calculating your credit score. Let's break down each one, starting with the most important. Number 1, payment history. At 35%, payment history makes up the biggest chunk of your credit score. It basically means whether or not you pay your bills on time. So if you're consistently late with payments and you have accounts open to collections, this is going to hurt your score and basically lower it. But if you consistently pay on time, you'll see positive results. The next factor is your credit utilization, which makes up 30% of your credit score. Your credit utilization is basically how much of your available credit are you using. And the rule of thumb is you want to use less than 30% of your total credit limit. So for example, if you have a credit card that has a $10,000 limit, you want to keep your spending below $3,000 on that credit card. The lower the utilization, the better. So moving on to length of your credit history, which makes up 15% of your credit score. This basically indicates the amount of time that you've built up credit history. Lenders like to see a long history of responsible credit use. Although a short history can also increase the score if it shows that you have been responsible with your credit overall. The next factor is credit mix, which makes up 10% of your credit score. This is about the variety of credit accounts that you have: car loans, mortgages, credit cards, etc. Having a mix of different types of credit indicates to lenders that you can manage different forms of credit responsibly. And finally, the final 10% of your credit score comes from new credit inquiries. So every time you apply for a new line of credit, a hard inquiry is added to your report, which can temporarily lower your score. So be careful when deciding to open new accounts. So now that we know how credit scores are calculated, let's clear up a few of the common myths. Myth number 1, closing a credit card will boost my credit score. So first off, closing a credit card doesn't automatically boost your credit score. In fact, it may hurt your score because it reduces your available credit and shortens your credit history. So think twice before you close that credit card account unless you absolutely need to. Myth number 2, checking your own credit score hurts it. When you check your own credit score through services like Credit Karma, that's considered a soft inquiry and has no impact on your credit score. Only hard inquiries, and that's when lenders pull your credit report to look at your credit history before they decide to issue you a loan or credit, can slightly lower your credit score. Myth number 3, paying off debt automatically erases it from my credit report. The truth is, when you pay off a debt, especially for late payments or accounts that were sent to collections, that record can still stay on your report for up to 7 years. So while paying off debts is a positive first step, the history of those late payments can still impact your score in the short term. Myth number 4, marrying someone with bad credit hurts your credit score. The good news is that's not true. Your credit score is yours alone, and marriage does not combine your credit scores. Although I do recommend that you sort this out before you get married, or if you're already married, that you work with a financial advisor to figure this out. However, opening joint accounts or co-signing on loans with a spouse can affect both credit scores depending on how the account is managed. So now that we've looked at how credit scores are calculated and busted some myths around them, let's look at some ways on how we can improve your credit score. Here are a few actionable steps. Number 1, pay your bills on time. Because payment history makes up 35% of your credit score, having missed or late payments can really hurt your score. So an action step that you can take is to set up automatic payments or reminders to ensure that all bills are paid on time. Number 2, work on lowering your credit utilization rate. Because credit utilization, or how much of your available credit that you're using, makes up 30% of your credit score, it's important to realize that a high credit utilization of above 30% will impact your score negatively. So an action step that you can take is to use less than 30% of your available credit limit. And you can do that by paying down your balances or requesting a higher credit limit. Number 3, pay off debts rather than moving them around. Consolidating your debt or moving the balances between credit cards does not reduce your overall debt, and it won't directly improve your score. An action step you can take is to focus on paying down your debts, especially the ones with the highest interest, while maintaining low balances on other cards. This will help reduce your overall debt and improve your credit utilization ratio. And finally, number 4, limit new credit applications. Every time you apply for new credit, a hard inquiry is recorded on your credit report. And too many hard inquiries over a short period of time can lower your score. So an action step that you can take here is to be selective when deciding to apply for new lines of credit and to avoid applying for multiple applications in a short period of time unless necessary. Improving your credit score may seem like a very daunting task, but it's totally possible if you take control of these factors. Remember, your credit score is more than just a number. It's the key to unlocking doors to better financial opportunities. And I hope this video helped you to understand better how your credit score is calculated and the action steps that you can take to improve your credit score. Thank you for watching my video. If you found this video helpful, please give it a thumbs up and subscribe to my channel for future content on financial fitness. Until then, looking forward to continuing on our financial fitness journey together, and see you in my next video.